Imagine waking up one morning, opening your bank account, and realizing that the system has been watching the movement of your money much more closely than you understood. Not just the dramatic transactions, not just wire transfers, not just brokerage accounts. Every deposit, every withdrawal, every time money moves from one place to another. Now imagine you are retired. You are living on a fixed income. You have savings that took you a lifetime to build. You are not trying to hide money. You are not running a business in the shadows. You are simply managing life the way you always have. You move money from savings to checking because a roof needs to be repaired. You help a child or grandchild because families do that. You sell an old car or a piece of jewelry or a few personal items you no longer need. Then one day a system that does not know you, does not know your history, and does not know your intentions begins treating your normal behavior as something that needs to be examined. That is why the number $10,000 matters so much. It is a small number in today's world, but inside the banking system it is still a very large trigger. And as we move into 2026, that number is going to matter in a different way than it did before. This is not about panic. Panic is almost always a bad decision. Making tool. This is about understanding the machine you are operating inside, because when you do not understand the machine, normal decisions can produce abnormal consequences. That is especially true for retirees. A retiree has a different financial pattern from a younger worker. A retiree may have Social Security deposits, pension deposits, required minimum distributions, proceeds from selling a home, gifts to children, inheritances, medical expenses, home repair payments, and periodic transfers between accounts. None of that is inherently suspicious. But to a system built on thresholds, patterns, and automated flags, the context often disappears. The system sees the movement before it understands the reason, and sometimes it never understands the reason unless you can prove it. Let me start with a simple example, because the clearest way to understand a system is to see how it touches an ordinary life. Patricia is 71 years old. She is a retired school teacher in Ohio. She has managed her own money for decades. Every month, her Social Security payment comes into her checking account. She has savings. She has no complicated financial life. She has never cheated on her taxes. She has never hidden money. She has never tried to outsmart anyone. But like many retirees, she sometimes has larger expenses. A roof has to be replaced. A medical bill arrives. A family trip comes up. A grandchild needs help. So Patricia moves money the way she has always moved money. She transfers from savings to checking. She deposits money when she sells something. She withdraws cash when she wants to pay a contractor or help a family member. To her, these are ordinary decisions. To a modern monitoring system, these can become signals. Not because Patricia did anything wrong, but because the pattern does not fit the narrow view of what the system expects from her account. That is the reality many seniors are moving into. The risk is not that every transaction becomes an accusation. The risk is that more transactions create more data. More data creates more automated comparisons, and more automated comparisons create more chances for a false signal. And when a false signal enters the system, the burden often shifts to the individual to explain what was obvious in real life but invisible in the data. To understand why this happens, you have to go back to the beginning. For decades, banks in the United States have been required to report certain transactions to the federal government. This comes from the Bank Secrecy Act of 1970. The logic behind that law was understandable. The government wanted tools to track money laundering, drug trafficking, tax evasion, and other illegal activity. Those are real problems. A society cannot function well if large amounts of criminal money move freely through the financial system. So the law required banks to file a currency transaction report when a customer deposited or withdrew more than $10,000 in cash. The important thing is not only the rule, the important thing is the time. That threshold was created in 1970. The number stayed the same, the economy did not. $10,000 in 1970 was a very large amount of money. In today's dollars, after inflation, it is roughly the equivalent of around $80,000. That means a threshold that once captured unusually large cash activity now captures many ordinary life events. This is how systems become dangerous without one dramatic change. The rule stays still, the world moves. And when the world moves far enough, a rule designed for one environment begins hitting people in a completely different environment. In 1970, a $10,000 cash transaction could indicate something outside normal life for most households. In 2026, a $10,000 transaction might be a used car, a medical procedure, a home repair, a gift to a family member, a retirement distribution, or proceeds from selling personal property. The number did not change, but the meaning of the number changed dramatically. That is one of the most important principles in understanding money and government systems. A rule can become more powerful simply because inflation makes normal life cross the old line more often, and the more often ordinary people cross that old line, the more ordinary people get pulled into a system that was not originally designed for them. Currency transaction reports are only one part of the system. There is another part that matters even more because it is less mechanical and more judgment-based. Banks can also file suspicious activity reports. A suspicious activity report does not require a transaction to exceed $10,000. It can be filed when the bank believes a customer's behavior may suggest illegal activity. The word to focus on is suggest. The bank does not need to know that something illegal happened. It only needs a reason to believe the pattern is unusual enough to report. One of the most important triggers is called structuring. Structuring means deliberately breaking a larger transaction into smaller pieces for the purpose of avoiding the $10,000 reporting requirement. If someone has $27,000 in cash and deposits $9,000 on Monday, $9,000 on Tuesday, and $9,000 on Wednesday because they want to avoid a report, that is not clever. It is a federal crime. The painful part is that many innocent people create patterns that can look similar without intending to evade anything. That is where retirees can get into trouble. Many older Americans grew up with a different relationship to banks. Some do not trust banks deeply. Some prefer cash because cash feels real. Some learn from parents or grandparents who lived through hard times. Some keep money at home. Some make smaller and more frequent transactions because that is how they have always felt safe. They are not thinking about federal reporting thresholds. They are thinking about control. They are thinking about habits built over a lifetime. But the banking system does not read family history. It reads amounts, dates, frequency, and patterns. That means a senior who is simply moving money in a familiar way can appear to an algorithm like someone trying to avoid a rule. This is why understanding the rule is not optional anymore. You do not need to be trying to do something wrong to create a pattern that looks wrong. And when the pattern looks wrong, the system can respond before anyone has taken the time to understand the reality. There have been real documented cases where citizens and small business owners had bank accounts seized because their deposit patterns looked like structuring, even when the money was legitimate, and no criminal charges were filed. The Institute for Justice and other civil liberties groups have reported on cases where people had to spend enormous time, money, and emotional energy fighting to get their own funds back. Think about what that means for a retiree. If you are living on a fixed income and $20,000 or $30,000 is frozen, that is not an inconvenience that can change your life. Legal fees can be high, time can be long, the emotional pressure can be intense. And all of it can begin with a pattern that could have been explained easily if the person had kept better records or understood the system before the transaction happened. That brings us to 2026. The phrase new IRS bank rule can sound like one sudden rule appeared overnight. That is not usually how these things work. More often, the system changes through funding, technology enforcement priorities, data connections, and administrative interpretation. The formal $10,000 threshold may remain the same, but the power around that threshold can increase. When the IRS receives more resources and upgrades its ability to analyze data, the same reports become more useful to enforcement. When banks deploy more sophisticated compliance software, the same transactions are watched in more detailed ways. When financial activity becomes more digital, the trail becomes easier to compare against tax filings. So the issue is not simply whether a new law says a new number. The issue is that the old number is being combined with modern data systems. That is a very different world. If a bank files a report and that report enters a federal database, it may never become a problem. Most reports do not become audits. Most reported transactions never result in a letter. That is important to say because fear should not replace judgment. But the risk is rising because the system is better at cross-checking. It can compare deposits against reported income. It can look for gaps. It can identify patterns that suggest unreported cash flow. It can connect transactions across accounts, institutions, and years more easily than it could before. This is where seniors are especially vulnerable, not because they are doing something wrong, but because their financial lives often involve irregular flows. A worker in their 40s may have a fairly simple pattern: paycheck in, bills out. A retiree may not. A retiree may draw from an IRA one month, receive an insurance reimbursement the next, gift money to a child after that, sell a car later, and deposit proceeds from a home sale the following year. The system may see volatility, the person sees retirement life. Those are very different interpretations of the same facts. One major concern is Social Security, pensions, and retirement account distributions. Many seniors receive monthly direct deposits that are well below $10,000. That seems simple, but then life creates a larger need. A required minimum distribution from an IRA can be more than $10,000 depending on the size of the account. A pension lump sum can be larger. A withdrawal from an annuity can be larger. A transfer from savings to checking to cover an expense can be larger. Those transactions may be perfectly legal and completely ordinary. But if the tax return does not clearly show where the money came from, or if the account activity does not match the reported income in an obvious way, the system can ask questions. The transaction is not the problem. The unexplained transaction is the problem. That is a principle retirees should understand deeply. The government does not need every transaction to be illegal to start asking why it happened. If the paper trail is clear, the explanation is usually simple. If the paper trail is missing, the same transaction can become stressful. Another major concern is gifting money to family. Seniors often want to help their children and grandchildren. They may help with college tuition. They may help with a down payment on a house. They may give money while they are alive because they want to see the benefit instead of leaving everything for later. That is natural, that is legal when handled correctly, but gifts can create reporting and documentation issues. There are annual gift limits, there are gift tax return rules, there are distinctions between a gift, a loan, reimbursement, shared expense, and payment for something else. Many families do not think in those categories. They think, I am helping my child. The system thinks, what is the source? What is the purpose? What is the recipient? And is it reported properly? Again, the human story and the administrative story are different. If a retiree transfers a large amount to a child, that may be perfectly appropriate. But if there is no documentation, no note, no record of intent, and no professional guidance when required, the transaction can become harder to explain later. A clean gift with clean records is one thing. A large unexplained transfer is another. The amount can be identical, the outcome can be very different. Home sales and inheritances create another risk point when seniors downsize, move closer to family, move into assisted living, or sell a second property. The proceeds can be large. A home sale can produce hundreds of thousands of dollars in cash flow into an account. That is not suspicious by itself, but it is large enough that it will be visible. The same is true for inheritances. When a spouse dies or when a parent's estate distributes funds, the money often comes in a lump sum. That lump sum then moves again into a bank account, into a brokerage account, into a savings account to pay bills, to cover taxes, to fund care, or to help family members. Every movement creates a record. If the estate documents, closing documents, and bank records line up cleanly, the system has an explanation. If the retiree has only a vague memory of what happened and scattered paperwork in a drawer, the same event becomes much harder to defend. This is the difference between being exposed and being prepared. The fourth area is everyday senior finance, which is often messier than people realize. A retired person may sell personal property, furniture, a car, jewelry, collectibles, tools, a recreational vehicle. Some of these transactions involve cash, some involve checks, some involve electronic transfers. A senior might also collect rent from a tenant, receive money from family members for shared expenses, or temporarily hold funds for someone else in the family. To the family, this may be simple. To the system, money moved in and out without clear business purpose. If the amounts are meaningful and the pattern repeats, it can look like income that was not reported, a business activity that was not documented, or money being structured. The system does not know whether the person is a retired teacher helping a grandchild or someone hiding income. It starts with the same data. That is why the answer is not to become afraid of moving money. The answer is to make sure that every meaningful movement has a clear reason and a clear record. You are not trying to hide from the system. You are trying to make sure the system sees the truth if it ever looks. Now let me explain what happens when a report enters the system, because knowing the chain reduces fear and improves decisions. When a bank files a currency transaction report or a suspicious activity report, the information goes to the Financial Crimes Enforcement Network, often called FinCEN, which is part of the Treasury Department. FinCEN collects this information and makes it available to law enforcement agencies, including the IRS. From there, analytical tools can compare the transaction data against tax returns, income reports, business records, and other information. If the system or an analyst decides something deserves attention, several things can happen. You may receive a letter asking for an explanation or documentation. You may be selected for an audit. In more serious situations, the matter can involve criminal investigators or the Department of Justice. And in cases involving suspected structuring, there is another tool that can be very damaging: civil asset forfeiture. This is one of the most important parts of the entire issue. In civil asset forfeiture, the government can seize money if it believes there is probable cause that the money is connected to a crime. The person may not be charged with a crime, the person may never be convicted of anything, but the money can still be taken, and then the person has to fight to get it back. That reverses the emotional experience of justice for the ordinary citizen. Instead of the government proving guilt in a criminal case before punishment, the citizen may have to prove that the money is legitimate in order to recover it. For a retiree, this is especially dangerous. Time matters, cash flow matters, peace of mind matters. A younger business owner may be able to fight for a long time. Though even that can be devastating, a senior living on retirement savings may not have the same flexibility. That is why the goal is to prevent ambiguity before it begins. You want your financial life to be explainable. You want your transactions to make sense, not only to you, but to someone who has never met you and is looking at data on a screen. That is the standard now. It may not feel fair, but good decision making begins with reality. The reality is that the majority of people whose transactions are reported are never contacted. Most reports disappear into the vast volume of data. That is true, but it is also true that the risk is real, especially for people with irregular money movements, poor documentation, heavy cash use, family transfers, or patterns that accidentally resemble structuring. So the question is not, how do I avoid every report? That is the wrong question. The right question is, how do I make sure that if my activity is reported, it is clean, documented, and easy to explain? That question leads to better behavior. The most important habit is record keeping. Records are not glamorous. They do not feel urgent until the day you need them. But in money matters, records are protection. If you sell a house, keep the closing documents. If you receive an inheritance, keep the estate documents and the bank records showing the transfer. If you take a retirement distribution, keep the statement showing the source and the tax form connected to it. If you give a large gift, write down the date, the amount, the recipient, and the reason. If you sell personal property, keep a bill of sale or at least a simple written note with the buyer, amount, and date. The record does not need to be complicated to be useful. A clear contemporaneous note can matter. A folder can matter. A spreadsheet can matter. The point is not perfection. The point is that your explanation should exist before anyone asks for it. When you create records only after a question arrives, the explanation looks weaker. When the record already exists, the transaction looks like what it really was: normal financial life, properly documented. The next habit is working with a professional when the transaction is meaningful. Not every money movement requires a lawyer or accountant, but retirement income required minimum distributions, gift rules, estate transfers, home sales, and unusual cash flows can interact with tax reporting in ways that ordinary people do not see. A good CPA, enrolled agent, or tax attorney who understands retirement issues can help make the picture clean. The goal is not to avoid lawful reporting. The goal is to avoid confusion. A professional can help you decide whether a gift tax return is needed. A professional can help you structure a family transfer clearly. A professional can make sure the income on the return matches the financial activity that might be visible in the banking system. In an age of automated cross-checking, consistency matters. When your bank records, tax forms, and explanations align, the probability of a serious problem falls. When they do not align, even innocent behavior can become expensive. The next principle is to avoid the appearance of structuring. This is crucial. If you need to move a large amount of money, do not break it into smaller amounts because you think that is safer. A single well-documented transaction over $10,000 is usually much less dangerous than several smaller transactions that appear designed to stay below the line. If you have $12,000 to deposit from a legitimate sale, depositing $12,000 and keeping the documentation is straightforward. Depositing $6,000 this week and $6,000 next week because you are trying not to trigger a report can create a much worse problem. The report itself is not the enemy. The appearance of evasion is the enemy. That is a principle many people misunderstand. They think the goal is to avoid attention. Often the safer goal is to be transparent and documented. If the transaction is legitimate, let the routine report be filed and keep your records. Do not create a pattern that makes an ordinary transaction look like an attempt to hide. The next principle is understanding your rights if you are contacted. If a letter arrives from the IRS or another agency, Fear can cause bad reactions. Some people ignore the letter because they are overwhelmed. Some people call immediately and say too much without understanding the issue. Some people try to fix a record after the fact in a way that creates more problems. Do not do those things. Read carefully, respond on time. Get representation if the matter is meaningful. You have rights. You have the right to representation. You have the right to answer in writing. You have the right to understand what is being questioned. A professional can often resolve a banking-related tax question with documents and a clear explanation. But time matters. The worst response is silence. The second worst response is panic. The best response is organized, calm, and documented. That is the way I try to approach every problem. Do not react emotionally to a system. Understand the system, then act according to principles. Families need to understand this too. Many seniors receive help from adult children. Many seniors help adult children. Money moves back and forth inside families all the time. One child pays for groceries and is reimbursed. A grandchild helps with technology and receives money. A son deposits cash into a parent's account to help with expenses. A daughter manages bills for a parent who no longer wants to handle every detail. All of this can be innocent, but innocent does not mean invisible if the amounts are significant. The family should document what is happening. If a family member is managing an older person's money, proper legal authority matters. A power of attorney or similar document protects both sides. Without it, a helpful family member can look like an unauthorized person moving money through an elder's account. The system will not know the family story unless the family has created a paper trail. That is why it is wise to talk before there is a problem. Who is allowed to help? What money is being moved? Is it a gift, a loan, reimbursement, shared expense, or support? How will it be recorded? These conversations can feel uncomfortable, but confusion is much more uncomfortable later. Clarity is kindness in financial matters. Checks and wires often create a clearer trail than cash. Cash is not illegal, but cash creates ambiguity. If you are helping a child with a significant amount of money, a check or wire with a memo and supporting records is usually clearer than an envelope of cash. If a family member is helping you, a documented transfer is usually clearer than repeated small deposits. The goal is not to make life complicated. The goal is to make the truth easy to prove. The next habit is staying informed. Rules change, enforcement priorities change, technology changes, funding changes, data analysis changes. The $10,000 threshold may stay the same, but the system built around it can become more powerful every year. That means a retiree cannot rely entirely on what was true 10 or 20 years ago. What worked before may not work now. The world changed, the cost of living changed, the data systems changed, and the penalties for misunderstanding the system can be large. Checking in with a tax professional at least once a year is not a luxury if your finances include meaningful retirement distributions, gifts, property sales, inheritance issues, cash transactions, or family transfers. It is part of risk management. And risk management is not about fear. It is about reducing the odds of a bad outcome. There is also an emotional side to this, and it should not be dismissed. Many seniors feel insulted when they learn how much of their financial life can be monitored. They feel as if after working hard, paying taxes, saving carefully, and following the rules, they are being treated as suspects. That feeling is understandable. There is a real tension in society between the government's need to fight financial crime and the individual's right to privacy and financial freedom. That tension is not going away. It exists in every modern financial system. The question is how to live intelligently inside that tension. Anger may be justified, but anger alone does not protect your account. Knowledge does, documentation does, good habits do, professional advice does, clear family communication does. That is how you reduce vulnerability. One of the biggest mistakes people make is thinking that fairness protects them. They say, I did nothing wrong, so I should be fine. In principle, that is how things should work. In systems, it is not always how things do work. In systems, outcomes often depend on evidence, processes, incentives, and interpretation. If your behavior is innocent but looks suspicious, you may still have to explain it. If your documentation is strong, the explanation is easier. If your documentation is weak, the same innocent behavior becomes harder to defend. That is not a moral judgment. It is a practical reality. Another issue is cognitive decline. This is sensitive, but it matters. As people age, some become less comfortable managing complex financial tasks. Some forget why transfers were set up. Some rely on family members. Some have automatic payments and deposits that they no longer fully track. This creates risk. If you are helping an aging parent or grandparent, You need proper authority and meticulous records. You should not be casually moving money in and out of their account without a clear legal and documentary basis. You may know your intentions are good, the system does not know that. A proper power of attorney, clean records, and clear notes can prevent a well-meaning family arrangement from looking like exploitation or suspicious movement. This protects the elder. It also protects the helper. Scams are another reason the banking system has become more aggressive, especially around seniors. Criminals target older adults because they know older adults often have savings and may be more vulnerable to pressure, fear, or urgency. Many scams involve moving money quickly. The scammer may tell the victim to withdraw cash. The scammer may tell them to make deposits below a certain amount. The scammer may tell them not to tell anyone. The scammer may create urgency. Act now. Keep it secret. Do not call your family. Do not call the bank. Do not ask questions. Those patterns can look like structuring or money laundering, even though the senior is actually the victim. That is another reason to slow down if anyone asks you to move money under pressure, with secrecy, or in an unusual way. Stop, talk to a trusted person, call a professional, call the bank through a verified phone number. The cost of slowing down is usually small. The cost of moving too fast can be enormous. The same principle applies to financial planning broadly. When the stakes are high, speed is often the enemy of good judgment. Scammers know that. Good systems should recognize that too, but your best protection is your own process. Do not let urgency override verification. There is also a civic side to this issue. The rules are not laws of nature. They are policies created by people. If a $10,000 threshold from 1970 no longer fits modern life, citizens can say so. If civil asset forfeiture creates unfair burdens for innocent people, citizens can say so. If financial privacy is being eroded too far, citizens can say so. Seniors have political influence because they vote, organize, and communicate. Organizations have raised concerns about civil forfeiture, financial privacy, and government overreach in banking data. The point is not to turn every retiree into an activist. The point is to recognize that these systems can be challenged, reformed, and improved. But while reform is debated, you still need to protect yourself under the current system. Principles work best when they separate what you can control from what you cannot control. You cannot personally control whether Congress changes the threshold. You cannot personally control how the IRS uses data. You cannot personally control whether banks become more cautious. You can control your records. You can control whether you structure transactions accidentally. You can control whether you get advice before a large transfer. You can control whether your family understands the plan. You can control whether your transactions are clear, documented, and explainable. Focus first on what you can control. That is how you reduce risk in any complex system. Looking beyond 2026, the direction is clear enough to take seriously. There will be political debates about IRS funding. There will be debates about bank reporting. There will be arguments about privacy, tax enforcement, fraud prevention, and the proper limits of government monitoring. Some proposals will be scaled back, some will be modified, some will disappear, but the larger trend toward more data, more automation, more cross-referencing, and more digital monitoring is unlikely to reverse completely. Technology makes it easier every year to observe financial activity. When something becomes easier, cheaper, and more useful to enforcement, systems tend to use it. That is not a prediction based on politics. It is a statement about incentives. Governments want tax compliance and crime prevention. Banks want to avoid liability. Software companies want to sell better monitoring tools. Regulators want fewer failures. All of those incentives point toward more visibility, not less. So retirees should not think of these habits as temporary. This is not something to learn once and forget. This is part of modern financial management, just as investors have to understand risk, cycles, inflation, and diversification. Retirees have to understand documentation, reporting thresholds, family transfers, and cash movement. The world became more complex. The answer is not to become helpless. The answer is to become more prepared. Let me make this very practical. Before you move a meaningful amount of money, ask a few basic questions. What is the source of the funds? What is the purpose of the transaction? Who is receiving the money? How will I prove this later? If someone asks, does this transaction need tax reporting? Would a check or wire create a cleaner trail than cash? Am I breaking this into pieces for a reason that could look like avoiding a threshold? Does my family understand what this transaction is? Do I need a professional to review it first? Those questions do not take long, but they can prevent months of stress. Good financial behavior is often boring in the moment and valuable later. That is true in investing. It is true in taxes. It is true in retirement. And it is true here. You worked your entire life to build what you have. You deserve to use it, protect it, share it, and enjoy it. But in the modern financial system, deserving something is not the same as being protected. Protection comes from understanding, it comes from habits, it comes from records, it comes from clear processes. The $10,000 rule is real. The reporting system is real. The increased use of data analysis is real. The risk to seniors who do not understand these rules is real. But your ability to respond intelligently is also real. You do not need to be afraid of your bank account. You do not need to stop helping your family. You do not need to stop selling property, taking retirement distributions, moving savings, or managing your life. You do need to stop assuming that the old informal way of doing things is always safe. That is the core lesson. The old threshold stayed in place while the world changed around it. The old habits stayed in place while the monitoring system became more sophisticated. That gap is where risk lives. Close the gap, understand the rule, document the transaction, avoid patterns that look like evasion, use professionals when the stakes are high, communicate with family, stay calm if contacted. And remember that the goal is not to outsmart the system. The goal is to make the truth so clear that the system has nothing meaningful to misunderstand. That is how you protect your money. That is how you protect your retirement. And that is how you keep control in a world where more and more of your financial life is being turned into data. The people most at risk are not usually the criminals. Criminals know they are trying to hide. The people most at risk are often the honest ones who assume honesty by itself is enough. Honesty is necessary, but in a complex system, honesty also needs evidence. Build the evidence before you need it. Because the best time to protect yourself is not after the account is flagged, not after the letter arrives, not after the money is frozen, and not after your family is confused. The best time is before the next meaningful transaction. That is how I would think about the 2026 banking environment. Not as a reason to panic, not as a reason to hide, but as a reason to behave like a serious person in a serious system. Know the rules, know the risks, know the patterns that get people into trouble, and build your financial life so it can withstand questions. Because when you can explain your money clearly, you are not helpless, you are prepared.